Hello and welcome back to the deep dive. It is Thursday, January 29th, 2026. We are just about to wrap up the first month of the year.
Already, yeah.
And honestly, if the rest of 2026 is anything like January has been, I think we are all going to need a very long vacation.
Or at least a very comfortable chair and maybe a seatbelt. It has been a volatile start to the year, to say the least.
Volatile is a very polite way of putting it. Look, I want to skip the small talk today because we have a stack of notes here that is, and I'm not kidding, it's literally heavy.
I saw that, yeah.
We need to talk about the number that's on every screen. I woke up this morning, checked the markets, and I honestly assumed it was a glitch in my app. I actually refreshed it 3 times.
I think I know exactly what number you're looking at, and no, it isn't a glitch.
Gold, the price of gold. I am seeing it trade between, $5,300 and $5,800 per ounce.
It's a number that feels like a typo, doesn't it? It just doesn't look real on the screen.
It feels completely fake. I mean, let's rewind the tape. Go back to, say, the pandemic era, around 2020. We were all staring at gold prices of $1,500, maybe $1,600 an ounce.
And we thought that was expensive then.
People were saying, oh, it's getting frothy at $1,600. So just 6 years ago.
That's right. Just 6 years. It feels like a lifetime ago, financially.
So in 6 years, the price has, basically tripled? And it's not even a steady tripling. To be honest, it feels like a huge chunk of that happened just now. In the last year, in 2025, it just felt like it went vertical. Like it jumped 70 or 90% in just 12 months.
Oh, it did. It has been an absolute rocket ship. There's really no other word for it.
So that's our mission for this deep dive. We are not just going to stare at the price tag and say, wow, we need to deconstruct this. How did a piece of yellow metal, which, let's be honest, it doesn't pay you interest, it doesn't run a business, it just sits there. How did it triple in value so quickly? Is this safe? Is it a bubble? Or is the money in our pockets just broken?
Those are the exact right questions.
Yeah.
And I think to answer them, we have to look away from the price tag for a moment. We have to look at what's happening behind the scenes, in the plumbing of the global economy.
Okay.
Because gold doesn't just move like this for no reason. It's usually a signal. It's telling us something about the world that, frankly, we might not want to hear.
Okay, let's unpack this. First, I want to talk about the shape of this chart. You use the word rocket ship.
Yes. In the financial world, we call this a parabolic move.
Parabolic. Okay, keep it simple for us. What does that actually look like for someone who's not staring at charts all day?
Sure. Think about hiking a mountain. A normal, healthy market is like a steady path up a hill. It's a nice diagonal line. It takes effort, but you climb steadily over time.
Okay, I'm with you.
A parabolic move is when that hill suddenly turns into a wall.
Yeah.
It just stops going diagonal and starts going almost straight up, a vertical line.
Like the shape of a hockey stick. It's kind of flat for a while, and then boom, the blade just goes straight up.
Exactly like a hockey stick.
Yeah.
That's a perfect analogy. And here's the paradox, the really strange thing about this situation.
Go on.
Usually, when an investment goes straight up like that, think about a crazy tech stock or some crypto coins a few years back, people buy it because they're greedy. They want to get rich quick.
Right. They're chasing the profit. They see the line going up and they want a piece of the action.
But right now, people are piling into gold because they are scared. They're not chasing wealth. They're chasing safety. That is the fundamental contradiction. You usually don't see a panic buy resulting in a get-rich-quick kind of chart shape.
That is fascinating. So usually a vertical line means I want a Lamborghini.
Exactly.
But this vertical line means I want to survive.
Precisely. They're running into what they perceive as the only fire escape in a burning building.
Yeah.
And that building is the global financial system.
So everyone is trying to squeeze through that one little door at the same time.
And that's what creates the vertical price chart. It's a stampede.
And the sentiment right now, it totally reflects that. Everyone I talk to, friends, family, they seem to be saying the same thing. Gold is safe. Gold never falls. Put your money in gold.
And when you hear everyone saying the same thing, when your taxi driver is giving you gold tips, that is usually when you should start asking some serious questions.
It's a classic contrarian indicator.
Absolutely. And we will get to the risks later because I promise you there are big risks. Nothing goes up forever without a break. But first, we really have to understand the engine. What is pushing this rocket so hard and so fast?
Okay, take us back. The research seems to point to a pretty specific time when this all really started to accelerate.
It does. We have to go back to 2022. It seems like a while ago.
Yeah,
But the seeds were planted then.
the start of the Russia-Ukraine conflict.
Correct. Now, I want us to be really clear. Let's put aside all the politics of the war. Let's not talk about who is right or who is wrong. That's not what this is about. Let's just look at the money.
Just the financial plumbing.
The plumbing, exactly.
Mm-hmm.
When that conflict started, the United States and its allies in Europe did something that it had never really been done on that scale before. They froze Russia's assets.
Right. I remember this was a huge story. And it was a massive number, wasn't it? Something like $300 billion?
Approximately $300 billion, yes.
Oh.
Now, you have to understand what this means. This wasn't, piles of cash hidden under a mattress in Moscow.
No.
This was money that belonged to the Russian central bank, their national savings, but it was sitting in digital accounts in Western banks, in New York, in London, in Frankfurt. It was held in dollars and euros.
And overnight, the U.S. and Europe just said, freeze.
Exactly. They turned off the access. Russia could look at their bank balance, see the $300 billion, but they couldn't touch it. They couldn't move it, couldn't spend it. It was gone. For all practical purposes.
Okay, so for Russia, that's obviously a disaster. But why does that make the price of gold go to $5,000 in 2026? Why does the rest of the world care so much?
Because the rest of the world was watching very, very closely. Imagine you are the finance minister of a country like China or Saudi Arabia or Brazil or India.
Okay.
You are watching this happen to a major global power like Russia, and the message you receive is crystal clear. It's this. If your money is in US dollars and you do something the United States disagrees with, whether it's a war, a trade dispute, anything, they can turn off your money.
It's like the bank manager calling you up and saying, hey, I don't like what you said yesterday, so I'm locking your checking account.
That is exactly what it is, on a global scale. And that single act, you could argue, broke the trust in the system. For decades, the US dollar and holding US government debt was considered risk-free. It was the safest thing in the world.
The bedrock of the whole system.
The bedrock. But in 2022, the world realized that holding dollars actually carries a new kind of risk. It's not a credit risk. The U.S. can always print more dollars to pay you. It's a political risk, a geopolitical risk.
So trust was broken? The unwritten rule, the handshake was broken?
Yes. And when trust in paper money, or more accurately, digital money, controlled by another country, when that trust breaks, where do you go?
You look for something else.
You look for an asset that no one can freeze. No one can delete with a keystroke. No one can hack into. An asset that no politician in another country can tell you that you can't access.
Gold.
Gold. It's just you and your gold.
Yeah.
If you have the physical bars in your own vault, specifically located in your own country, the U.S. government cannot freeze it. The EU can't freeze it. It is physically, tangibly yours.
So that leads right into the question of who is actually doing all this buying. Because, my neighbor bought a gold coin and I bought a little bit of jewelry for my wife last year, but we didn't push the price to $5,000.
No, you certainly didn't. The massive price increase we are seeing is not driven by regular people like you and me. Not primarily.
Yeah.
It's driven by the whales, the biggest buyers in the ocean.
The central banks.
The central banks. These are the institutions that manage the savings for entire nations. And since that moment in 2022, specifically between 2022 and the end of 2024, they went on the biggest gold shopping spree in modern history.
A shopping spree?
We are talking about record-shattering amounts, year after year.
How much gold are we talking about here? Can you put a number on it?
Over 3,000 tons of gold were bought by central banks in that short period alone. And that's just what's officially reported.
3,000 tons. That is hard to even visualize. Which countries are at the front of this line?
Well, it's a list of the countries we just mentioned, the ones who might be worried about U.S. power. China is a huge buyer, consistently, month after month. India has been buying aggressively. Russia, obviously, is trying to rebuild its reserves with gold. Turkey as well. It's a global phenomenon outside of the traditional Western alliance.
And their goal is what people are calling de-dollarization.
Right. That's the buzzword, but I think it's simpler to think of it like a breakup. They are slowly, methodically breaking up with the dollar.
How does that work in practice?
They are selling off their U.S. Treasury bonds, which are basically loans you make to the U.S. government denominated in dollars, and they are using the cash from those sales to buy physical gold.
So they're literally swapping paper IOUs from the U.S. for physical metal.
That's the trade. And I read a statistic recently that I think is critical. For the first time in decades, for some of these major countries, their reported gold holdings are becoming larger than their U.S. Treasury holdings.
Wow. That's a huge shift.
It's a monumental shift. For 50 years, the standard playbook for any country was get dollars, keep dollars in U.S. bonds. That was safety. Now, the new playbook is get dollars, trade them for gold immediately. It is a massive vote of no confidence in the paper currency system.
So reason number one is trust, a breakdown of trust. They don't trust the sanctions. They want monetary independence. But there's another side to this, isn't there? It's not just about war and politics. It's about the value of the dollar itself.
Yes, this is the other equally important pillar of the bull market. This is the simple economic math.
And this is the debate I have with my friends all the time. Is gold actually becoming more valuable, or is our money, our dollars, just becoming worth less?
That is the ultimate question. And if you look at the data, it strongly suggests that money is becoming worth less. To understand this, we have to talk about the debt.
The national debt. I feel like this number changes every time we speak, but last I checked, the U.S. national debt had crossed $38 trillion.
$38 trillion. And it's accelerating. It's a number so big the human brain can't really comprehend it. But let's make it simple. How does a government pay off that much debt? Or even just pay the interest on it?
Well, they can't just collect more taxes. That would never be enough.
It's not enough. There aren't enough rich people or corporations to tax to cover that kind of deficit. So they do what governments have always done throughout history. They print money.
Or in the modern world, they don't even have to run the printing presses. They just type extra zeros on a computer screen at the central bank.
Exactly. They expand the money supply. But here is the most basic rule of economics, something you learn on day one.
Yeah.
If you have more of something, each unit of it becomes less valuable.
Supply and demand.
Supply and demand. If everyone had a Mona Lisa painting in their living room, the Mona Lisa wouldn't be special or valuable. When a government prints trillions of dollars to pay its debts or fund its spending, the value of each individual dollar bill in your pocket goes down.
This is inflation.
This is inflation. But we usually think of inflation as prices going up. We walk into the grocery store and say, oh, eggs are so expensive, or gas is expensive. I think we need to flip that thinking on its head.
Flip it how?
It's not that the egg is more valuable. The egg is still an egg. The chicken doesn't know about the global economy. It's that your dollar is weaker. It takes more of your weak dollars to buy the very same egg.
Ah, okay. So the egg is constant. The dollar is the variable that's changing.
The dollar is the sinking ship. And it takes more of those sinking dollars to buy the same ounce of gold, which is acting like a life raft.
Precisely. Gold is the mirror. It's just reflecting the devaluation of the currency. Gold tends to keep its purchasing power over centuries, while the dollar, or any paper currency, loses it over time.
I like the analogy of traveling. You know, sometimes you go to a foreign country where their currency is crashing. You look at a menu, and a cup of coffee costs 10,000 of their currency units.
And you feel shocked, like, what is going on here?
Right. But right now, for Americans, or for anyone holding dollars, it feels like we are all tourists in a country called the past, and our money buys way, way less than it used to.
That's a great way to put it. It's a slow-motion version of that. This is what financial people call debasement, right?
Yes, currency debasement. The currency is being debased, made less valuable by the creation of new units. And this is where the inherent scarcity of gold becomes so incredibly important. You can print dollars, you can print euros, you can print yen. You cannot print gold.
It has to be mined out of the ground with immense effort and cost.
Exactly. And you had a great visualization for this earlier when we were prepping. I think this really helps people understand just how rare gold is.
Yes, this always blows people's minds. It puts everything in perspective. Imagine if you took all the gold ever mined in all of human history.
Every wedding ring, every gold bar in every central bank, every coin from ancient Rome and Egypt up to today.
All of it. And you melted it all down into one solid cube. How big do you think that cube would be? Does it fill a football stadium? A skyscraper?
No, Not even close. It would be a cube that is only about 22 meters wide on each side.
22 meters, that's it. For all the gold in the world.
That's it. That is roughly the height of a 6 or 7-story building. That is all the gold we have. Everything humanity has ever fought wars over, coveted, and cherished fits into that relatively small box.
That is just... It's wild. It's hard to believe.
So on one hand, you have this tiny, finite cube of gold that is physically limited. On the other hand, you have a mountain of paper and digital money that is growing endlessly, trillions upon trillions being created every single year.
When you put it that way, it's almost obvious why the price has to go up. You are chasing a tiny, fixed supply with an infinite, expanding demand for a safe asset.
Exactly. The scarcity is real and it's permanent.
Okay, so we have the central banks buying for political reasons. We have the trust issue with the dollar. We have the debt and the printing of money. But it's not just gold, is it? I've been hearing a lot about the poor man's gold recently.
Ah, silver. Yes. We absolutely cannot talk about this rally without talking about silver.
Because silver has been going crazy too, right?
In many ways, silver's story is even more interesting than gold's right now. It has also tripled, or in some cases even more than that, in value. But the driver for silver is slightly different. It's a bit more complex.
So.
Gold is mostly money, let's be honest. It sits in a vault, it sits in a jewelry box. It doesn't really do anything. It's a store of value. Silver goes to work.
It has a job.
It has a very, very important job in the 21st century. It's a critical industrial metal. We need silver for everything that defines the modern technological future.
Like what?
We need it for solar panels. Massive amounts of it are used in every single panel. We need it for electric vehicles, EVs. It's one of the best conductors of electricity, so it's in all the electronics.
In missiles, right. I heard the defense industry uses a ton of silver.
A huge amount. In guidance systems, in satellites, in smart bombs, in missiles. And here is the key difference between gold and silver in industrial use.
Okay.
When you use a tiny bit of gold in a computer chip, it's so expensive that companies spend a lot of money to recycle it and get it back. When you use silver in a missile that explodes, or in millions of tiny consumer electronics that get thrown away, often that silver is gone. It's consumed. It's lost to the system.
So the available above-ground supply is actually being used up and disappearing.
In a way, yes. We're using it up at a ferocious rate.
Yeah.
So you have the monetary demand people buying silver coins because they can't afford an ounce of gold.
Right.
And that's running headfirst into this massive, non-negotiable industrial demand.
It sounds like the perfect storm, the setup for what some people call a super cycle.
That is the term economists are using. And it's not just gold and silver. If you look at copper, zinc, aluminum, they're all hitting highs. It suggests that the world is incredibly hungry for basic raw materials. But silver has that unique dual personality. It's half money, half industrial metal.
And some people are saying that because the silver market is so much smaller than the gold market, it could actually move even faster than gold from here.
It's definitely possible. The entire market for silver is tiny compared to gold. It takes a lot less new money coming in to move the price significantly. So if gold is a steady rocket, silver can be like a firecracker. You'd be very, very volatile, both up and down.
Okay, so everything sounds amazing. Gold is great, silver is great, the dollar is dying by everything. Wait, see you shaking your head over there?
I am shaking my head because this is the dangerous part of the conversation. This is where people get hurt.
This is the reality check.
This is the big reality check.
Yeah?
Look, trees don't grow to the sky. Nothing goes up in a straight line forever without a correction. And when we see a parabolic move, that vertical wall we talked about at the beginning, history, tells us to be very, very careful.
You have some examples from history, right?
Yeah.
Because we have absolutely seen this movie before.
We have multiple times. Let's look at 1980. That is a famous or infamous year for gold investors.
What happened in 1980?
Gold absolutely exploded upwards. It was a time of very high inflation. There was an oil crisis, a war in Afghanistan. It's unfamiliar at all.
Very, very familiar. It's almost the same script.
Yeah, exactly. Gold went up over 300% very, very quickly. Everyone was euphoric. But then the Federal Reserve raised interest rates to fight inflation. The panic subsided and gold crashed. It fell 65% from its peak.
65%.
Yeah.
A 65% drop would destroy you.
It destroys you if you bought at the top. And it didn't recover to that price for decades. Let's look at a more recent example, 2011.
I remember that one vividly. Gold hit nearly $2,000. which was an all-time record back then.
$1,920 to be exact. And the narrative was the same. The U.S. had just printed tons of money after the 2008 crisis. Everyone thought gold was going to 5,000 back then.
I didn't.
It didn't. It hit the peak, and then it fell 45% over the next few years.
And it wasn't just the size of the drop, right? It was the time it took.
That is a part people always forget. It's not just about losing money. It's about losing time. After 2011, gold went sideways, meaning the price didn't go anywhere for 5 or 6 years. It was what investors call dead money.
So if you put your life savings in at the peak of 2011, you basically made zero profit for half a decade, while other things, like the stock market, were growing.
Exactly. While the stock market was roaring back while real estate was recovering, your money was just asleep in gold. That is the opportunity cost, the risk of buying a parabolic move at its peak.
So, based on history, after a straight-up move like the one we've just seen, what kind of crash or correction, to be polite, should we expect?
If history is any guide, after a move of this magnitude, a correction of 20 to 40% is not only possible, it's very normal.
20 to 40%. So if gold is at $5,000 right now, it could easily drop back to $3,000 or $3,500.
Easily. And that would be considered a healthy correction on the long-term charts. But for a regular person who just bought their first coin at $5,000, seeing a 40% loss is absolutely terrifying.
And that's driven by FOMO, isn't it? The fear of missing out.
It is the single biggest enemy of the average investor. When you hear your taxi driver talking about gold, when you see it on the front page of every newspaper, when your coworkers are bragging about how much money they made, that is usually the time to be the most careful.
When everyone is cheering on the balcony, it might be time to get out of the building.
Or at the very least, stop buying more. Don't add to your position at the peak of the euphoria.
Okay, so let's get practical. We have listeners right now who are thinking, okay, I understand the risk, but I also understand the dollar is weak. I want to own some gold. How do they do it without, losing their shirts?
The first and most important rule is position sizing. Do not go all in.
So don't sell the house to buy a stack of gold bars.
Please don't. I've heard stories of people doing this. They think the world is ending tomorrow, so they sell everything to buy gold. Even if the world is struggling, going all in on any single asset is incredibly dangerous. The golden rule, pun intended, is to keep about 10 to 15% of your total investment portfolio in gold.
Just 10 to 15%? That might seem low to some people who are really worried right now.
It's enough. Think of gold as a mattress.
A mattress? Explain that.
Yes. A mattress isn't an engine. It doesn't drive the car forward at high speed. It's not going to make you rich like a great tech stock might. But it is a cushion. If the economy crashes, if the stock market falls 50%, your gold is the mattress that softens the blow. It protects you on the downside.
I like that. It's insurance, not a lottery ticket.
Exactly. It's about wealth preservation, not aggressive wealth creation.
Now, what about the how? How do you actually buy it? Physical versus digital. I know there are very strong opinions on both sides of this.
There are, and there are pros and cons to both. Let's start with physical gold. We're talking about buying coins, bars, maybe some jewelry.
The stuff you could actually hold in your hand.
Right. The pro is obvious. You hold it, you own it, it's yours. If the internet goes down, if the banks have a holiday, if the whole system freezes, you have it right there.
Yeah.
There's a strong cultural and psychological value to this, especially in places like India or China.
But the cons must be significant too.
They are. First is storage. Where do you put it? If you keep thousands of dollars of gold at home, you risk theft. It's stressful. If you put it in a bank safety deposit box, you have to pay fees, and it's not accessible 24/7.
And it's not cheap to buy, right?
Right. When you buy physical gold, there are making charges or premiums over the market price. You always pay a little bit more, and you need a lot of money to start. You can't buy a gold bar with $10.
Okay, so what is the alternative for someone who just wants to start small?
The alternative is digital gold or ETFs, which stands for exchange-traded funds.
Explain what an ETF is really simply.
Think of it like buying a share of gold. You don't actually own or hold the metal yourself. A big trusted company holds thousands of gold bars in a secure vault, and they issue digital certificates or shares that represent ownership of a tiny piece of that gold.
So what's the advantage of doing it that way?
It's incredibly easy. You can buy it on your phone in seconds through any brokerage app. You can sell it just as quickly. But the biggest advantage is the entry price. You can buy a share of a gold ETF for the price of a cup of coffee. You can invest $10 or $50 or 100 rupees, whatever your currency is.
So it's really good for small retail investors to get started?
It's perfect for them. But there are downsides. You don't get the satisfaction of holding the shiny metal. And there is a small, what we call counterparty risk. You have to trust the company that says they're holding the gold for you.
That makes sense. Now, you mentioned something really important earlier about when to buy. You said don't buy it all at once.
Yes, this is crucial, especially right now with prices at an all-time high. If you have, say, $10,000 that you've decided to invest in gold, please do not buy $10,000 worth of gold today.
Because if the price drops 20% tomorrow, you're immediately in a really bad spot.
You're immediately underwater and you'll panic. A much better strategy is called SIP, a systematic investment plan. Or in the West, we often call it dollar cost averaging.
And that's just buying a little bit every month on a schedule.
Exactly. You break up your $10,000. You buy maybe $500 worth this month, $500 next month, $500 the month after that for 20 months.
How does that help?
It smooths out the risk. If the price goes up, great, your investment is growing. If the price crashes next month, that's also great, because your $500 now buys you more gold at a cheaper price. You get to average out your purchase cost over time.
It takes the emotion and the guesswork out of it.
It completely removes the need to time the market. Because nobody, not me, not you, not the biggest experts on Wall Street, nobody knows for sure what the price will do tomorrow. This method protects you from your own bad timing.
That brings us really to the psychology of all this, because investing isn't just about numbers, it's emotional. You asked me a question before the show started about my tolerance for the color red.
Yes, this is the question I always ask people before they invest in anything volatile. How much red can you see in your account without panicking?
And by red, you mean seeing a loss.
Right. If you open your investment app and you see your gold position is down 20%, what is your gut reaction? Do you say, okay, this is a long-term investment, I'll be fine? Or do you feel that knot in your stomach and have the urge to hit the sell button to make the pain stop?
I think for most people, the instinct is to sell, to stop the bleeding.
And if you are that type of person, you should not be buying big amounts of gold right now at an all-time high, because gold is volatile. If you can't handle seeing red, you won't survive long enough in the market to ever see the green.
It really all comes down to patience.
It does. There's a famous quote by Warren Buffett. He says, "The stock market is a device for transferring money from the impatient to the patient." And it's true for gold, too.
That is so true. I know so many people who stop their monthly investments when the market is down. They see the red and they say, oh, I'm losing money, I'm stopping.
Which is the exact wrong time to stop. When the market is down, that is when assets are on sale. That is when you should be buying more, not less. But our human nature makes us want to buy high when everyone is excited and sell low when everyone is scared. We have to actively fight that instinct.
And I think this connects to just general financial habits, too. We're talking about gold today, but this applies to everything.
Yeah.
You mentioned the danger of lifestyle creep.
Yes, we see this all the time, especially with young people. They get their first good job or they make a little profit in crypto or gold, and what is the first thing they do?
They buy a luxury car or the newest, most expensive phone.
They want to look rich, but in doing so, they are preventing themselves from ever becoming rich. I like to use the bucket analogy.
You're right.
Imagine your wealth is a bucket, and you were trying to fill it with water or with gold.
Yeah.
But if you have a hole in the bottom of the bucket, and that hole is a car payment, credit card debt, spending on expensive clothes, you can never, ever fill the bucket.
No matter how much water you pour in at the top, it just flows right out.
Right. So the advice is simple. Build your asset column first. Plug the holes in your bucket. Let your assets, your gold, your stocks, your real estate, let them buy your luxuries later on. Don't buy the luxury first and starve your assets.
That is really solid advice. Don't buy the fancy car in your first year of working. Buy the gold or the stock or the bond and let that grow until it can buy the car for you without you having to work for it.
Exactly. Patience pays. Compounding pays.
So let's try to summarize everything we've learned today. This has been a whirlwind tour of the global economy.
It has been, yeah.
Gold is at these crazy prices, over $5,000, because of what really is a perfect storm of factors.
It is. Reason one, a fundamental distrust in the U.S. dollar, triggered by the 2022 sanctions. Countries want assets that they can control, that are outside the Western system.
Reason two, the big players, the central banks, are buying record amounts of physical gold to protect their national savings and diversify away from the dollar.
Reason three, the debt. The U.S. national debt is over $38 trillion, and the only way to manage it is to print money, which devalues the currency and makes hard assets like gold look more attractive.
And I guess reason four is just fear. War, instability, economic uncertainty. Gold acts as a kind of insurance policy against chaos.
That is the perfect summary.
And the warning, the big but.
The warning is, don't get carried away by the hype. Trees don't grow to the sky. Parabolic moves almost always end in a sharp correction. Don't go all in. Stick to the 10-15% rule.
And always use that mattress analogy. It's there for sleeping soundly at night, not for racing down the highway.
Perfect. Couldn't have said it better myself.
I want to leave our listeners with one final thought. We were talking before about an analogy for investing, using the idea of sweetness.
Yes. I think investing is a lot like eating sweets.
You should eat enough sweets to enjoy the taste.
But not so much that you get diabetes.
I love that. So with gold, invest a moderate amount. Enjoy the gains if they come. Use it as protection. But don't gorge yourself on it so much that a sudden crash ruins your financial health.
That is the key to longevity in this game. Moderation and patience.
So to everyone listening, take a good look at your portfolio. Take an honest look at your bucket. Are you buying gold because you truly understand the macroeconomic reasons, or are you just buying it because your neighbor did and you have FOMO?
Ask yourself why you are buying, not just what you are buying.
Because that critical thinking is your best asset. It's probably better than gold in the long run.
Absolutely.
Thank you so much for breaking this all down for us. It is a crazy time in the markets, but having this context makes it all a little less scary and a lot more understandable.
My pleasure. Stay safe out there, everyone.
We will see you next time on The Deep Dive.